You see it in the headlines every single day, right? The S&P 500 is up, the S&P 500 is down. We all treat it like this big scoreboard for the economy, but that little number hides a much, much bigger truth. See, this index isn't just a passive tracker. Oh no, it's an active force that's actually shaping the market, steering the flow of trillions of dollars. So let's pop the hood and really uncover the hidden power of the S&P 500. Here's what we're going to cover. First, we'll bust a huge myth that stops way too many people from ever getting started with investing. Then, we'll dig into what the S&P 500 actually is and reveal its secret power. After that, we'll walk through a surprisingly simple formula for building wealth, and we'll wrap it all up with the single most important rule for success: how to win by simply not panicking.
All right, Section 1. Let's get right to it and tackle the biggest thing that holds most people back.
This quote from Mark Tilbury just hits the nail on the head. We've all been told that investing is some secret club for the super rich, that it's way too complicated, or that you're pretty much guaranteed to lose all your money. The experts kind of want you to believe it's a game you can't possibly win without them. But what if the simplest approach was actually the best one?
Check this out. This slide is the ultimate proof. The legendary Warren Buffett made a $1 million debt. He said that a simple, cheap S&P 500 index fund would absolutely smoke a hand-picked group of fancy, expensive hedge funds over a decade. And the result? The S&P 500 didn't just win, it crushed them. I mean, it wasn't even close. It's the perfect example of how you do not need to be some Wall Street wizard to win this game.
So if this simple tool can beat the supposed pros, what in the world is it? Let's jump into Section 2 and break it all down.
So at its core, the Standard & Poor's 500, or S&P 500 for short, is basically a list that tracks 500 of the biggest companies in the US. But here's the key phrase: it's market value weighted. Now what does that mean? It just means that giant companies, like an Apple or a Microsoft, have a way bigger impact on the index's final number than the smaller companies on the list. So it's not just some random collection, it's a carefully chosen snapshot of what the US economy is really doing. And getting into this index, well, it's like trying to get into a super exclusive club with a really tough bouncer. A company can't just be big. It has to be consistently making money. It needs to have a ton of shares available for people like you and me to trade. That's the public float. And it needs strong liquidity, which just means you can buy and sell its stock easily without the price going haywire. There's an actual committee at Standard & Poor's that makes sure every single company is a stable, mature industry leader.
Now let's compare that super strict, rules-based system with the other one you always hear about, the Dow Jones. The Dow is old school. It's just 30 companies that are kind of subjectively picked by editors at the Wall Street Journal. And here's the really weird part: it's price-weighted. That's basically a historical glitch that means a stock trading for $500 has 5 times more say in the index than a stock trading at $100, even if that $100 company is way bigger. The S&P 500 is just a much more modern and accurate picture of the real market. Okay, so we get the rules, but now we get to the really fascinating part. Let's dive into Section 3, where we uncover how the S&P 500 doesn't just measure the market, it actually moves it.
This is a phenomenon called the inclusion effect, and it's wild. When that S&P committee announces that a new company is joining the index, something amazing happens. Every single fund in the world that tracks the S&P 500, and we're talking about trillions of dollars here, is now forced to go out and buy that company's stock so their fund still matches the index. This creates this huge, guaranteed tidal wave of buying that almost always sends the stock price soaring.
And the real-world impact of this is just staggering. I mean, when Tesla was added back in 2020, index funds had to scramble to buy something like $70 billion worth of its stock. It was pure chaos. And there's a huge symbolic power here, too. A while back, when Salesforce replaced ExxonMobil in the Dow, it was like a massive public announcement. Cloud software is replacing big oil as a main engine of the American economy.
Of course, the flip side is just as dramatic. Getting kicked out is the ultimate public demotion. When a giant like General Electric was dropped from the Dow after more than 100 years, it sent a devastating signal to the entire world that the company was in serious trouble. And then, all those funds were forced to sell their shares, making the problem even worse. These aren't just little administrative changes. They are major moments that mark a real shift in economic power.
Now, the most important part of all this is that this powerful, self-correcting index is available to literally everyone. So let's get to Section 4 and see how you can plug this amazing tool directly into your own financial future.
Let's just run through a simple scenario. Imagine you invest $500 a month into an S&P 500 index fund.
Based on its long-term average return of about 10% a year, after a decade, you'd have just shy of $100,000. That's an amazing start, but if you look at the growth, it seems pretty steady, pretty linear.
But this is where the magic of compound interest really kicks in. Let's keep going for another 10 years. Now, you might think, okay, another 10 years, maybe it'll be double, around $200,000. But nope, not even close. It's almost $350,000. Why? Because now all your investment returns are earning their own returns. That growth curve is starting to bend upwards in a big, big way.
And if you just stick with it for about 31 years, boom, you cross the $1 million mark. The growth at this point is just explosive. And get this, you only put in about $186,000 of your own money. The other $900,000, that's all from investment gains. That is the unbelievable snowball effect of long-term, consistent investing.
Okay, so how do you actually do it? The two most common ways are with ETFs and mutual funds. An ETF, that's an exchange-traded fund, is the really simple one. You can buy and sell it all day long, just like a share of Apple stock. A mutual fund is a little different. All the buying and selling only happens once a day, after the market closes. Honestly, for a long-term investor, both are fantastic, super low-cost options.
So the formula is simple. The tools are easy to get, so what's the hardest part? It's not the math, I promise you. It's our own brains. Let's get into our final section, winning by not panicking.
If you look back, the history of the stock market is just a history of one crisis after another. You had Black Monday in '87, the dot-com bubble bursting, the 2008 financial meltdown that dropped the market by more than half, the COVID crash. These moments felt like the end of the world. But what is the one single thing they all have in common? The market always recovered, and it always went on to hit new highs. Downturns aren't a bug, they are a normal feature of the journey.
And this is exactly why discipline is everything. When the market is nosediving, every single instinct in your body is screaming at you to sell and stop the bleeding. But as this great quote from Sequoia reminds us, the best move is very often no move at all. Panicking and selling at the bottom just guarantees your losses and ensures you miss the recovery that has always followed. The real key to long-term success is just to stay the course.
So, we'll leave you with this final thought. The S&P 500 isn't just a static list. It's a living story of economic evolution. It went from being dominated by industrial companies to energy companies, and now to software and AI. The index is always changing to reflect who really holds the economic power. So the question is, what's the next chapter? What new industry, biotech, renewables, space exploration, is going to be so disruptive that it forces the next great reshuffling of the S&P 500? That's the story that's still being written.